Hello and welcome back to the Retire While You Work podcast. My name is Carson Odom, a wealth advisor here at Adams Wealth Partners, joined this week by Myles Zuger, another wealth advisor here at Adams Wealth Partners, and founder and CEO of Adams Wealth Partners, David Adams. And we're lucky enough this week to be joined by a local guest, John Bellenfant, owner of Bellenfant CPAs here in Nashville, Berry Hill, just outside of town. John, thank you for being with us today.
Yeah, absolutely. It's a pleasure to be here. Thanks for having me on.
We're excited to start over the next few weeks to start having a few guests on our podcast. We think it's gonna lead to a lot of great conversations about some financial planning topics, and obviously today our focus is going to be on the tax area. And John, just as like a kickoff for you, why don't you give a little bit of background about yourself and how, give a background about how you got started in the accounting industry.
Yeah, I grew up around it. My father is a CPA, and I'm the third of three kids, and my other two siblings decided to not do it. And so he went one for three. So I always say one for three is not too bad. But yeah, I grew up around it. So my dad had a local firm. So, I worked there in the summers and went over there and did landscaping on weekends, all the fun stuff. And, when I was going to college, I wasn't exactly sure I wanted to do. I kind of had an interest in architecture, and he was like, "Hey, if you don't know what you want to do, major in accounting. You always have a job." And I said, "Well, that sounds pretty nice." So went to school, did well in accounting, stuck with it, and yeah, just enjoyed it. So here I am.
Awesome. And I'll say, been doing this 22 years. I'm also a CPA, as is Carson, and had a chance to meet a lot of other CPAs in Nashville. And what we like about John from the time we've known him is just his, he's still in the game. He's not looking to retire. I don't think so over the next couple of years. I feel like he's very proactive with our clients. He's thinking ahead. He's planning based. Whereas I've noticed, no offense to a lot of CPAs out there, but what we've experienced is a lot of times they're just up to their face in tax returns, and they don't really have the capacity to maybe do some proactive planning. And we've really enjoyed with John. We've sent clients his way, and he's been able to do some of that, which really kind of helps enhance the planning that we're doing. So the right arm's talking to the left arm, and our job is to really be not do the tax return. We can't give tax advice per se, but we can be a second set of eyes for clients and at least be the quarterback between them and a CPA like John to say, "Hey, John, John and Cindy Smith, we're looking here. It looks like maybe they need to consider doing a Roth IRA conversion or whatever it is," and bounce that idea off of him so that the client is really getting that full holistic planning component that a lot of times is missed just because the advisor is too busy, the CPA is too busy, and nobody really takes the time to do the planning. So that's really the backbone and kind of the foundation of why we look for CPAs like John, and why we refer him to clients.
Yeah, it's not, even for myself too. I never saw myself going into the accounting industry, and kind of, you were surrounded by it, John. But and same for David. I don't know if David, you ever saw yourself just growing up and
I did not. I was also doing landscaping. I was cutting yards at 12. I just knew I liked managing money and keeping up with spreadsheets and things like that.
I don't feel like you don't hear a lot of kids say their dream is to become an accountant.
Accurate, very accurate. But like you said, I feel like a lot of people can see the accounting industry or a CPA license as, okay, even if I don't want to do it forever, I can get into another industry by having a good amount of experience like that. So that's good. But I'll just kind of lead off what you're already talking about, John. So we have clients that work with us and that we also work closely with their accountants. So on the wealth management side, can you tell a difference on when one of your clients is working with their wealth advisor? Can you tell a difference in the planning when a wealth advisor is involved with you?
Yeah, I think so. A lot of it's education, right? So if you're having kind of some of those conversations and you have a financial advisor who's, touching base with their client and really kind of answering their questions, and they fully understand not only what their, personal balance sheet is on kind of y'all's side of the table, but what that means on our side of the table from a tax perspective. It really just makes it a lot easier. and not having to have those initial kind of education introductory meetings. We're happy to do those, but if they've already kind of done that and they already have kind of a business acumen level to them, we can go ahead and just jump to, being a little bit better at our job, right? Because sometimes you get a little too distracted, or that first meeting, you have to be so, low level, base level, elementary. You can't get into the planning and the strategy, and, that maybe somebody who not only is a high net worth individual, but a small business owner, you start adding a lot more opportunities for deductions and credits, and just a lot more things you can do in that scenario. But yeah, somebody comes in from our experience working with you guys is they're very in tune with their holdings, and they understand that when events are taxable and not taxable. And so it really just allows us to kind of be a little bit more strategic and talk like tax only items with them. So it really
Is there, a time that's a better time for clients to come in and have planning conversations with you, versus it being, obviously people are coming in January and February saying, "Hey, John, here's all my stuff. Can you do my return?" But do you have what is a good time of year for them to come in and say, "Hey, let's think about the next year," that sort of thing?
April 14th, April 13th. Is that usually the best time?
Yeah, no, it's not.
That's shocking.
I will tell you how many new clients that we do take on in Q1. I think it's they have a bad experience or whatever makes them want to seek out a new CPA. They sometimes don't think about that at the end of the year. They think about it at the turn of the year when it actually is tax season. They're like, oh, but we'll talk to people throughout the year, absolutely. But I think the best time is just throughout the year. It's never a bad time. And if you do wait until the turn of the year and it is tax season, oftentimes for a cash basis taxpayer, it's too late, right? And we can go back and try and capture as much as possible, and maybe they can make some retirement account contributions with you guys, by April 15th, or if it's a set by October 15th, and we could deduct that. But honestly, the planning and strategy aspect of our job is over at that point. So yeah, if you want to change CPAs, or you're looking to do some strategy or planning throughout the year, is great. Oftentimes we have, the number one complaint we hear about taking on new clients from other firms is they want that proactiveness, they want that strategy, they want that planning. So we'll oftentimes tailor a quarterly tax consult that aligns with their quarterly estimated tax payment. And we don't try and sell them on it or anything like that, but it's just a good time for us to touch base, even if it's a quick call, answer any questions they have, see if they have any business decisions they need to make that's going to make an impact on their tax liability. We can even have it as a roundtable where we're all on the call, financial advisor, us, maybe the attorney needs to be on for estate planning, whatever it needs to be. And then they can always say no too, right? Hey, no, I think last quarter we nailed everything down. We're in good shape. Let's talk again. But I think definitely, kind of either Q1 or Q2, there needs to be some kind of planning. And if you miss out on that, you absolutely want to do it in Q4, because once January 1st hits of the following year, it's oftentimes too late to do too much.
I agree. I do think the kind of the best, most proactive planning conversations are always during the summer. It's because you don't have any, or you don't have near as many tight deadlines from your perspective going on. April 15th has already passed. The October 15th extension deadline isn't quite here yet, so it's a little bit slower. So then you can have the time, the relaxing conversation where kind of the pressure is off, or the burden's not on your shoulders, or the stress of completing tax returns, where you can sit back, relax, and think and do planning, as opposed to all the other conversations on April 2nd. It's all in hindsight. You're all just looking backwards, trying to say, wait, I didn't think about this, or what can we do because this happened, but it's not in the year in which you can really make an impact for the future. So I agree. I think summer's a great time to have that conversation with an accountant.
And John, have you seen any just kind of common tax mistakes that people make, and just kind of ways to avoid them? I know that's kind of a generic question, but are there ones lately that are they come to you and you're like, oh gosh, they haven't been writing this off, or this is just something they've overlooked, or is there kind of a common theme or mistake you've seen?
Yeah, it's all over the board. A really, really simple one is sometimes people don't understand that filing on time means like, like if they file late, it's an extension of time to file, not an extension of time to pay. So if you have a tax liability at April 15th and you don't pay it, just because you filed an extension doesn't mean that, you're good. You still need to pay in whatever you think your tax liability is going to be for the previous year.
So like if you're extending till October 15th, and the deadline is April 15th, but you file an extension, you still need to, a lot of times people don't pay anything, but you still need to pay in, at least get close to what you think you're going to owe, and then true it up by October 15th.
That's right. Yeah, it's going to accrue penalty and interest. The penalty is going to accrue every month that it's late, and then it's 0.5%. And then, you're going to have interest daily charged on that and the actual tax liability itself. If you don't make quarterlies, there's also an estimated tax penalty, so that's also going to be a factor. But yeah, I think it's just a common misconception. I think people get a little mixed up too when they're used to, maybe they've been a W-2 for several years or for the entirety of their career, and they change to being a small business owner. I mean, that's a huge transition. You should absolutely consult with somebody during that to fully understand why you need it. But, the comparison I always draw for people is when you're W-2, let's say you get paid biweekly, you have 26 payments going to IRS every year. Well, when you go self-employed, they just want 4. So time value of money, if you miss one of those, absolutely, they're going to charge you a penalty. They missed out on 3 months of, whatever low interest bearing thing they're doing government. But
how come they don't give you? How come they don't pay you? How come they don't pay you interest when you overpay and get a refund?
They do. They do, but not unless it's within the filing deadline. So like if you go back and amend, for instance, let's say you go back and amend your 22 return now, and you have an amount of refund, they will pay you interest because you were due that refund in the 2023 calendar year. So they'll be a couple of years. It's not very high, but they'll give you some. But yeah, other than that, sometimes people miss, deductions around their vehicle. There's 2 ways, right? You can either take mileage or you can deduct it and take actual expenses. So just kind of weighing those 2 options. Sometimes you see people take both. Sometimes you see people take neither or the way less beneficial option. Some people just don't even know about HSAs, which blows my mind. I mean, I have 3 young kids. My 4th one's almost here. If you have any kind of family or even just yourself, you're going to use an HSA. Might as well put some money into it and deduct it. Now, of course, that's assuming you are qualified to do that because you're in a high deductible health plan. But
why do you
fan of HSAs? Big fan of HSAs.
Why do you think that's one people miss? Do you think it's because they don't know how to set it up, or maybe one isn't offered through their employer, or they just don't think it's that big of a benefit?
Education. They just don't know it's there. Or maybe it's not there, or they don't see the benefit. But the floor is so high to deduct medical expenses too, that if you have any medical expenses, you should put money in there.
And using that as like a long-term, basically another IRA. I mean, for anyone, I feel like a broad recommendation is to fund an HSA. Don't use it for medical expenses if you can afford those medical expenses outside of the HSA, so that you let that HSA sit and grow and become a really, really tax deferred type of account for a long time from now when you're 60 plus. So,
yeah,
I mean, it really is a powerful account.
One thing that we do see that's kind of relevant to you guys is advisory fees are actually deductible against the net investment income tax. So if you're, a high earner, you're going to pay net investment income tax on your investment income. So interest, dividends, cap gains, rental income. So it actually adds up quite a bit to folks because, it seems like the natural progression of people who are successful is they get really, really good at what they're doing. And then they start giving money to you guys, start investing in real estate. And so they build up this investment income pool, and sometimes it outweighs their earned income. But as that grows, that net investment income tax grows too. So if you can find anything to deduct against it, it's great. But yeah, any fees paid to an advisor like yourself is actually deductible against that net investment income tax.
Gotcha.
That's good. Yeah. That's a good point.
And we also hear a lot of time, these guys have heard it from me, but also from clients like, gosh, I'm paying too much in taxes. Are there any deductions that, anything else we can do? We hear that from clients all the time. So are there any other common deductions that you see that people miss out on? Is there like something that's kind of like the most common, I guess?
That one specifically that I just mentioned, sometimes, we'll have folks who are small business owners who do their own bookkeeping, and they'll submit their books to us, and it's just like, oh my goodness, negative asset or negative liability accounts or whatever it might be. And it's like, just honestly, just having a professional look at your books before you put it into a tax return, they could identify God knows how much. And also, going back to kind of our planning discussion too, if you're having those throughout the year, oftentimes whatever fee we're charging, we're finding them in tax savings 5-fold plus. Sometimes it's like astronomical what we find. So it's always beneficial. And if you're a very simple taxpayer and you just have a few tax forms, and there's not a whole lot of planning there. But yeah, if you're a small business owner, real estate owner, high net worth individual, all of a sudden you kind of add more and more to your plate, to your personal balance sheet, the more we can kind of be a strategic partner and actually save some serious tax dollars.
I think that basically the high W-2 earner is kind of the worst, quote unquote, worst place to be as far as income tax goes, because other than maxing out your 401k or contributing to an HSA, you really have nowhere to go as far as, like finding tax deductions. It's not like they exist and you're just not taking advantage of them. They just don't exist if you're a high W-2 earner. And it's just not a place where you can just find a lot of deductions at that point.
Yeah. When we see some really high W-2 earners, I will say that oftentimes it is because they have some embedded stock options in those W-2 wages. So there are some planning opportunities oftentimes, like around RSUs or timing around that, which is kind of more in y'all's wheelhouse. But yeah, at the end of the day, if you've got nothing but tax forms that you're entering into your tax return, W-2s, 1099s, and that's generally it. There's not a whole lot to go there. Another one that sometimes people don't see is the child independent care credit, but both parents have to be working in order to get that. So if somebody has kids and, it gets phased out and it gets, down to a really low number, the more you make, but it's something that we oftentimes see that people weren't taking advantage of previously.
What about switching gears a little bit, thinking ahead? There was the big, beautiful bill that just passed, and there's some tax changes that came with that. We've been reviewing it. I'm sure you have also, but any notable planning opportunities that you see coming down the road from that next year?
Yes, quite a few. The biggest and best one is just increased depreciation thresholds. I mean, it's just music to our ears. It makes our job a lot easier when we can, communicate good tax changes versus bad. It's like, hey, yeah, let's send this email out as soon as possible. Whereas if it was the other way, it's like, let's make sure this is correct. But Section 179 allows you to 100% depreciate equipment, vehicles, furniture, fixtures in the first year. That threshold got increased from $1 million to 2.5. So that's a massive increase. And then bonus depreciation is 100%. So generally speaking, you like to use 179 first because states all conform with 179. Then you use bonus because a lot of states disallow bonus. So basically what that means is, like, for federal income tax purposes, if you use bonus, that's fine. It lowers your taxable income, but the state won't honor it. It'll only allow you to deduct it over the useful life of the asset. So your state taxable income at that point is a little higher. So yeah, you want to maximize your 179 first, then your bonus is 100%. But bonus was 60% last year. It was phasing down 20% per year, so it was going to be 40% this year. But yeah, it being back up to 100% is massive. Staying in the business column, I'd say, the qualified small business stock exclusion opportunity went from 10 to 15 million. We just consulted with somebody. We're actively getting somebody. Who I think we're going to be able to do a statutory conversion from a partnership to a corp in order for them to be a 1202. And their plan is to grow this business. Is probably already worth this amount, 10 or 15 million. So in 5 years when they can fully extend this, it's going to be great. But they also allowed some partial credit. Like if you hold it for 3 years, you can get partial qualified business, small business stock. If you hold it for 4 years, you get even more, but 5 years gives you that full $15 million exclusion. And obviously that's not around very often, right? That's primary exclusion.
And you in a couple of minutes, can you explain to our listener, like what is QSBS? Like what's the easy way to explain who that applies to and how it works?
Yeah, you got to have a C Corp. And basically, if you are under the beginning thresholds, there's a few things you've got to check the box on in order to meet this criteria to switch your company to a C Corp, or maybe you're already a C Corp. You've got to hold the stock for 5 years. And if you can hold it for 5 years and meet all the other criteria, there's certain industries that don't apply. Like I don't think you can be an accounting firm and do this. Like you can't be in the healthcare. There's a few others.
It's a lot of startup. It's a lot of startup tech companies and stuff that use it, right?
Yeah, we were consulting on one as a manufacturer today.
Oh, okay.
And yeah, startups could work. A lot of tech can work for it. But basically, if you meet the holding period requirement of 5 years minimum, you check the few boxes. It's not too many, and you sell that stock for $20 million gain. Essentially, the first 15 million is not taxable, so you're paying $5 million capital gains tax on a $20 million gain. Yeah. Yeah, and like I said, the primary residence exclusion of $250K for single, $500K for married filing jointly. Those exclusions just don't exist in the Internal Revenue Code very often. So when you see them, you can take advantage of them. Please cling on to them. That's a big one for the taxpayer. Yeah, and then on the individual side of the new tax law, a lot of the provisions from the Tax Cuts and Jobs Act just got made permanent. We increased the standard deduction, child tax credit. There's a new $6,000 deduction for senior citizens if they make under 150K. No tax on tips or overtime. That's an interesting piece. That's going to be a learning curve. One thing for the planning side that you guys could really utilize, and that we're definitely going to try and utilize, is the state and local tax cap. It got increased to 40K. So, we don't have a state income tax here in Tennessee, but they can still deduct sales tax and property tax. And property taxes have gone up 50%, like the 2 or 3 times now over the past 5 to 10 years. So, but there's a phase out if you make between 500 and 600K. So if you make over 600K, your state and local tax deduction is still capped at 10,000, which was the previous deduction. But if they make under that, or they live in California or New York or one of these high, state income tax, they're going to be able to deduct 40,000 of their state income tax, which is great. And yeah, if you weigh somebody who's on the towing the line, you can actually, there's actually like a 45% effective tax rate if you tow the line. Like if you're able to actually take advantage of it and get under the 500,000 or right at the end of the 600,000, you could save, it's basically like a 45% effective tax rate. Other things, the state tax exemption going up to 15 million is awesome. So
that's right. Yep.
And that's going to be locked in now and just be indexed for inflation now, right? So it's not going to be, I guess every administration won't I guess they can always change it, but it should be kind of locked in for a while, right?
Yeah, that's a good question. I know it's effective first in 26. And I think you might be right that it's going to stay that way. And then, other than that, the other couple things would be vehicle interest is not deductible if you make under 100K as a single or 200K as married filing jointly. That's a weird one. And then they're weakening itemized deductions, which is I don't love, but the top tax bracket's 37%. And so if you're in that tax bracket, you can only get a 35-cent savings on your itemized deduction. So basically, you can only deduct 35% of your itemized. That's yes, or mortgage interest, or property tax, or the SALT cap, like we were just talking about. There's also, starting in 26, going to be a charitable floor of 1%. So basically, if you make, 500,000 is your taxable income, there's a 1% charitable floor. The first 1% of your charitable giving of your taxable income is not taxable. So that was a weird one too. So yeah, it was big enough change that there's going to be some learning curve that people probably need to understand a few of these items, just because a lot of these individually won't make a big difference, but if you factor them all in, I mean, it can make a huge difference.
Sure. That's why you have a job, right?
That's right.
Been in business a few more years.
That's right. I think what was the back Tax Cuts and Jobs Act? Didn't Trump say that he was going to make it where you could fit your tax return on a postcard? I think that was his big selling point, was how you could fit a tax return on a postcard. And now it's back to where it was, and it's just a normal 2 pages plus all the other forms attached to it. So we've gone nowhere.
Which is typical of politics.
Yeah.
A lot of conversation that doesn't really get anywhere.
Yeah.
It's been great.
Yeah, trying to make taxes and everything as interesting as it possibly can be. I know it's not the most exciting topic in the world, but like you said, it's super easy. I feel like the bar is set low on how to be proactive and take advantage and do some planning in your tax. And the tax aspect of someone's financial plan is, if you want to be proactive, it's super easy. Have a conversation with your accountant during the summertime. Loop your financial advisor in. All of a sudden, you are probably ahead of 99 out of 100 other people by doing those two things. Just communicate.
There are so many people that, like John alluded to early on, that'll just take all their receipts or something from their business and dump it to their accountant, and then somebody in the office just kind of keys stuff in, but there's no communication, no real strategy session. And you have no idea if, like, John or somebody like John could take on a new client that's been doing that kind of in that sloppy fashion for years, and they may find out, you're able to go back and amend 4 returns and get, a $20,000 refund or something that could justify any of their fees times 10. I have clients every once in a while like, well, how much, I've had my CPA forever and they were only charging, $500, and how much, David, do your people charge? And I explained to them, like, I'm not sure it's going to be more than that these days. That's an old school rate. But the better question to ask is, if somebody's being proactive or can go back and amend a return, the fees are only an issue in the absence of value. They may more than quadruple that. So at least 1 year, go pay market value. Go pay a CPA that you like and you feel like is proactive, that your wealth advisor has had experience with, and say, hey, how much would you charge me to do X, Y, Z? Pay them a fair price and see what happens. And hopefully, and if they tell you worst case, you're like, oh, you're a past CPA or you did everything exactly right. You don't need to change anything. You can then decide to pay them, or you can go back to doing it yourself. But very rarely do we send somebody to a CPA that we've kind of vetted and they end up like saying it wasn't good, or they want to change or go back to doing it themselves. So
I'll give you 2 examples just for fun. We had one client we took on who had 3 partnerships, and in the middle of their partnerships and them under here, they had an S corp, right? So they flowed all the income through the S corp to them, right? So they only got the 1K1 from the S corp. And so what that did is it fully removed their qualified business income deduction. And we said, well, you should change it to where these 3 partnerships go to you and the S corp can go to you too. That's great. And so since we flowed all 4 of them to this taxpayer individually, it saved them $75,000 per year, just because they got an increased qualified business income deduction. And they were able to make this change retroactively. So we were able to amend, and they did get paid the $75K plus interest.
That's great.
Plus a percent.
Is there a limit on how many years you can go back when you're looking at a scenario like that?
Past 3.
Okay.
3.
Yeah, the past 3. And then, yeah, and that's all that's also available for audit. So if you're selected for audit, they can only audit one of the past 3, but based on their audit, they can look back as far as 7 years, and that's kind of the
statute. Yeah.
But unless it's like willful neglect, or they find something like criminal, or
then there's no statute if it's fraud.
No statute. Yes.
You are in trouble.
That's right. That's right. They're going to come knocking, getting their money.
I got one question for you, John. Since we're big on marketing here, I've always wondered with your logo, it's a blue box with a bunch of numbers in there. Are they random, or is there any significance to those numbers?
No significance, man. Okay. Just a bunch of numbers thrown together. It looks like maybe this is an accounting firm.
I like it.
There you go. Now I know.
Message received.
Nice and honest. Appreciate it.
Right.
Oh, great. Thanks so much for your time today, man. This has been great.
Yeah, absolutely. Always a pleasure working with you guys. Really appreciate you guys. And I do think that you guys are some of the best financial advisors here in Nashville, but also across the nation. You guys do a great job, and having some CPAs on staff, really makes this roundtable that we have with mutual clients super effective.
Thank you for that. We appreciate it.
We appreciate you saying that.
Yeah, thanks for everything, man. We'll be in touch, and thank you so much.
Yeah, thank you.
Yep. Thanks for joining the Retire While You Work podcast, and we'll see you next week.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.